Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. What a week. Let's jump in. US stock markets suffered a dramatic reversal on Tuesday, ending sharply lower after the White House confirmed that President Donald Trump would move forward with a sweeping increase in tariffs on Chinese goods. The announcement raised early optimism and triggered another wave of volatility across global markets. The benchmark S&P 500 index fell 1.6% by the close, retreating from a peak gain of 4.1% earlier in the day. The technology-heavy Nasdaq composite slowed more than 2%. And the Nasdaq 100 remains deep in bear market territory. Tuesday marked the fourth consecutive session of violent swings on Wall Street as fears over a prolonged US-China trade war, as well as a global trade reset, have rattled investors and sent markets into a tailspin. The source of the renewed anxiety was a White House statement confirming that tariffs exceeding 100% on certain Chinese imports would go into effect just after midnight in Washington. These new duties, amounting to an additional 50%, build upon a series of retaliatory trade measures, taking the total levy above 104%, with some goods hitting 120% or higher. The market reaction was swift. Oil prices tumbled as fears of a global economic slowdown resurfaced. Crude dropped as much as 4.1% to $60.26 a barrel USD, a level not seen since the early days of the COVID-19 pandemic. The downturn in oil added to concerns that higher tariffs could choke off demand and slow global growth. The bond market offered little relief. Yields on US Treasury securities dropped as investors sought safety and bet on potential Federal Reserve rate cuts. The 2-year yield declined sharply, while the 10-year Treasury yield, which has already fallen by 40 basis points this year, continued its slide below 4%. Strategists noted that global investors are increasingly looking at alternatives to US debt, particularly as yields in Europe and Japan have risen modestly. Germany's 10 bond yield now stands at 2.66%, while Japan's has risen to around 1.25%. Making them more attractive to international buyers when adjusted for currency risk. Quote, "The 10-year yield is going vertical. Something is going to break," end quote, warned the chief market strategist at Corplay. His comments reflect growing concerns that sustained market turmoil, compounded by aggressive trade policies, could prompt a systemic financial disruption. Equity futures suggest more pain ahead too. Contracts tracking the S&P 500 and Nasdaq 100 were down 1.5% and 1.7% respectively in early Wednesday trading, while Europe's Stoxx 600 futures fell 4.2%. The US dollar also weakened 0.6% against a basket of global currencies, reflecting reduced investor confidence in America's economic trajectory. Meanwhile, China's response has been firm. Premier Li Qiang reiterated Beijing's commitment to, quote, "fight to the end," end quote, stating that China has ample tools to, quote, "fully offset," end quote, the negative effects of US actions. As we discuss on my other channel, China Update, in today's episode, which goes up an hour after this episode, however, China is deeply vulnerable to a drawn-out trade war with the United States, with limited tools to fight back. With nearly a year's worth of stock market gains now wiped out for the S&P 500 and little clarity on the path forward, investors are bracing for continued volatility. Until there is meaningful progress on the diplomatic front, markets are likely to remain gripped by fear, or at least uncertainty, caught in the crossfire as the US resets the global trade order. Now, before we move on to Asia and Europe, where markets continue to plunge, one more US update. In a dramatic move, President Donald Trump and Defense Secretary Pete Hegseth have pledged to propose the first ever $1 trillion defense budget, a record-breaking figure aimed at bolstering US military strength. The announcement came Monday during a press event with Israeli Prime Minister Benjamin Netanyahu. Trump stated the proposed budget would be, quote, "in the vicinity," end quote, of $1 trillion, emphasizing the need for a strong military in uncertain times. Later that evening, Hegseth confirmed the plan on X, writing, quote, "coming soon, the first $1 trillion at Department of Defense budget," end quote, and vowing the funds would focus on, quote, "lethality and readiness," end quote. The proposed budget marks a major leap for the current $892 billion allocation, which funds the Pentagon, nuclear development, and other national defense programs. It also arrives ahead of the expected federal budget rollout in late May, surprising many in Washington. As part of the overhaul, Hegseth plans to cut tens of thousands of civilian Defense Department positions and consolidate both domestic and overseas bases. While Trump did not clarify if the $1 trillion applies solely to the Pentagon, national defense spending was already forecast to surpass $900 billion. Quote, "We have to be strong," end quote, Trump said on Monday, adding, quote, "Nobody's seen anything like it," end quote. Let's now move to Asian markets. If you're getting some value from today's episode of Market Update, don't forget to hit the like button. And if you want to continue to be on top of the most up-to-date news and analysis on global markets around the world, maybe consider subscribing. Hit the bell notification icon and you will be. Asian stocks plunged on Wednesday as fears of an escalating US-China trade war and volatile Wall Street trading triggered a wave of investor panic. Japan's Topix index led the regional slump, dropping 3.6% within the first 45 minutes of trading. Equity brokers in Tokyo dismissed Tuesday's brief rally as a, quote, head fake, end quote, suggesting a deeper, more sustained downturn could follow. All three of Japan's major banking groups saw their shares fall by approximately 5%, reflecting a broad-based market retreat. The yen, meanwhile, settled in the mid-145 range against the dollar after spiking overnight. In Australia, the benchmark index opened 2% lower, and the Australian dollar fell below $0.60. BHP shares dropped 4% amid renewed concerns about global iron ore demand. One trader warned that Tuesday's buyers may quickly lose confidence if the downturn continues. South Korea also faced sharp financial strain as the won, its currency, plunged to its lowest level since the 2009 global financial crisis, touching 1,487.36 per dollar. Heavy foreign selling and a weak Chinese currency added to the pressure as investors expressed unease over the country's ability to respond diplomatically to tariffs following the impeachment of former President Yoon Suk-yeol. In China, the market braced for the 104% US tariff hike, sending stocks tumbling. Hong Kong's Hang Seng Index dropped 3.2%, with its tech sub-index down over 5% at opening. Mainland China's CSI 300 slipped 1.2% at opening. The offshore currency hit an all-time low of 7.429 against the dollar, while investors fled to safety, pushing China's 10-year bond yield down to 1.65%. Meanwhile, the Association of Southeast Asian Nations will send a delegation to Washington to discuss newly imposed US tariffs that have hit the region's exports hard, Malaysia's Prime Minister Anwar Ibrahim announced on Tuesday. Speaking at an event in Kuala Lumpur, Ibrahim acknowledged limited room to challenge the motivations behind the tariffs, but emphasized the adjustments in their implementation could still be pursued. Quote, "The global trading system is under intense strain, more so than at any point in recent memory," end quote, he said. The tariffs have raised alarm throughout Southeast Asia. Countries like Vietnam and Indonesia, whose economies rely heavily on exports to the United States, are feeling the brunt of the policy. Vietnam, which has the third largest trade deficit with the United States after China and Mexico, has already taken steps to reduce tensions. The Prime Minister said Hanoi will expedite the purchase of US defense goods and commercial aircraft and has requested a 45-day delay in the implementation of tariffs. Vietnam also plans to review non-tariff barriers on US products. The impact is being felt across industries. Vietnam's fisheries sector, where over 90% of seafood is handled by local businesses, has seen shares in major exporters plunge by 25% after the announcement. The US is Vietnam's largest fishery export market, accounting for roughly 20% of sales. In Thailand, Thai Union Group, the world's top canned tuna producer, faces challenges as around 40% of its revenue comes from North America. Similarly, Vietnam's Song Hong Garment, a supplier of brands like Gap and Walmart, could see up to 80% of its sales disrupted. Indonesia, while facing lower tariff rates compared to Vietnam and China, hasn't escaped the economic fallout. The Jakarta Composite Index plunged 9% on Tuesday, triggering a trading halt. The currency dropped to a record low of 16,850 against the US dollar, prompting aggressive intervention from Indonesia's central bank to stabilize the currency. While the Association of Southeast Asian Nations delegation hopes to find common ground in Washington, the broader message is clear. Southeast Asia's export-driven model faces an existential crisis. And finally for today, with so much doom and gloom and so much heavy material, let's end on something a little bit lighter and more positive. The UK government has secured a landmark deal with Universal Destinations and Experiences to build a theme park in Bedfordshire, a project ministers are calling a vote of confidence in Britain. Prime Minister Sir Keir Starmer formally announced the agreement today, Wednesday, after months of behind-the-scenes negotiations. Expected to open in 2031, the park is projected to deliver a £50 billion boost to the UK economy, creating 20,000 construction jobs and 8,000 permanent roles across hospitality and the creative industries. Backed by US media giant Comcast, the attraction is forecast to welcome 8.5 million visitors in the first year, making it the UK's largest. Chancellor Rachel Reeves praised the investment as a signal that Britain remains a top destination for global business. The government has committed to significant infrastructure upgrades, including road and rail links, though details of the investment package remains undisclosed. The development will anchor the broader Oxford-Cambridge corridor project alongside the expansion of Luton Airport and completion of the East-West Rail line. Planning approval is expected soon, with expedited processes in place. Universal also plans to collaborate with local colleges to train a new generation of workers, cementing its long-term commitment to the region. The announcement represents a nice bright spot in an otherwise gloomy economic picture. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Don't forget to like and subscribe if you haven't already. This is a tremendous help for independent channels like this. Have a good Wednesday, or as good as one can with everything that is happening in the world today. Thank you again for watching, and I will see you all tomorrow.